Rajesh Baheti, MT at Crosseas Capital Services, is now joining us live. Mr. Baheti, thank you so much for taking out time for us. Could you just tell us about the up move that markets have seen and what it has done to a lot of F&O data that you track? Are IVs at historic lows, and that's probably a sign that one should start to get a little bit cautious about the outlook?
Yeah, so before, at the time of the budget and soon after that, I said that the market looks very, very good for a sharp rally, and that rally has played out. But obviously, the markets seem to have a collective belief that by the end of the year, we are going to get close to 10,000 on the Nifty. But what I find a little surprising is the market seems to have a collective belief that the path to 10,000 will be a very smooth one. And there could be any number of factors that could, disrupt this path towards 10,000 and make it a little more rocky than what the market seems to believe. And the IVs are at the kind of levels that I have not seen since the F&O section was launched by the NSE, at sub 9% for, out of the money calls, just 1-200 Nifty points out of the money. The calls are selling at below 9% IV, even not only for May, but even June IVs are sub 9%, which is kind of levels that I've not seen ever in my life. So it makes it very, very difficult to kind of trade the market, except that you kind of can go long straddles or strangles on the market, specifically 100 out of the money to 200 out of the money. But again, if the market kind of plays out the way the people are thinking it would, then again it becomes difficult to trade that, because the IVs and the levels of the option prices keep falling every day, because the market seems to have stabilized at these levels. So it's a very, very difficult market for Nifty traders. A little more easier for stock traders because stocks are moving all over the place. There's a large bull run taking place outside of the Nifty, which I think is much bigger than the Nifty that we've seen. So there, I think people are making a lot of money. People are ignoring Nifty. But some geopolitical, some factor, something out of somewhere has to shake this market up. I don't know what's going to do it. But this kind of IVs can't continue for long.
Right. But, if IVs have to go up, do you see a significant correction in the market, or it will be a knee-jerk reaction which will last for a few days and then you again start this move on the higher side?
Oh, that's a very difficult call to make. Fundamentally, I think, let's leave apart the Nifty. I think fundamentally, if you take the broad market, I think there is a consensus that we are overpriced. We are grossly overpriced, maybe to the tune of 25 to 30% on the broader market. And if we see some kind of a correction on the broader market towards some kind of an equilibrium pricing, which is 20-25% below the current levels, then certainly it will damage Nifty also, and the IVs will go up. So what is going to trigger this, I don't know. Right now, it all seems hunky-dory, because everything seems to be falling in place for the government in Delhi in terms of winning elections, getting stronger, as well as making some policy efforts to change the way our taxation is done. But I think some jerk, something that comes maybe externally or internally that could shake this a bit is needed, because I think market should never get complacent. But for the moment, they seem to be very, very complacent. So it's a difficult market to trade in.
Right. In terms of the valuations, the mid-cap valuations that you were seeing. Yeah, I know you don't look at that, but you look at broadly the data which comes in from the F&O side, or the trend which is there in the market. Are you getting worried that valuations are very, very high? And any day when the derating would happen, it could be a big one?
Absolutely. It always plays out. 2007, it has played out. In 2014, when we hit the 6,400 mark, again it played out. It can play out anytime. The mid caps have gone up largely on the back of domestic buying. So, and I've been saying that for some time, that as long as there's very, very strong domestic buying, I think the mid caps are going to keep getting overpriced and more overpriced, because the domestic audience really likes the mid cap story. It's not so much into the large caps on the indices as it's in the West, where, the index plays are the biggest money drawers. So out here, the domestic investors are sold on to the mid-cap story. The thing is, in April, I think the margin trading books must have opened again, and some of it is going to get very, very leveraged. And when that leverage comes in terms of deleveraging by way of some margin calls at a trigger of 5-10% below these prices, that's when I think the panic buttons will be hit. So till that happens, I think people are quite secure, feeling that they can buy another stock today which will go up 10-15% in the next month or two.
Right. You think options or call writers are the ones that can create panic once there is a movement in the market?
Well, that always happens, whenever the option volatility actually follows the market volatility, not the other way around. So whenever the market volatility reduces, the option volatility also goes down. And once that happens, I think the market volatility spikes up again due to any of the factors I said, external, internal. And once that happens, again, the volatilities go up, and then the markets kind of stabilize at some level. So for option writers, I think it's a dangerous place to be in today. You've got to be very, very careful. At the same time, given the current state of the markets, option buyers are not making money. But if you have the patience, I think the way to trade these markets, at least in the next 2-3 months, is to go long options.
Right. So what will be the strategy when you say you have to go long options? Both call and put is what you would suggest to buy?
If you look at the skew in the option calls and puts, I think the out-of-the-money puts are still okay in terms of the IVs, but the out-of-the-money calls are really, really cheap. The one way to play the market would be to buy out-of-the-money calls and maybe, start shorting the Nifty futures against it and trade the futures, 200 points down, you buy back the futures and sell back the calls. So this strategy is actually called gamma scalping, where you buy the calls and then sell the futures and trade the futures with the options. And once the option IVs go up again, then you can exit this strategy. So maybe for the time being, leave the puts apart, buy calls and then sell the futures slowly.
Right, but what are you trying to achieve when you are buying calls and selling the futures? What essentially are you trying to achieve? How would one make money? At what level would investors start to make money?
Yeah, so the theory behind doing this is that the market may not go up in a straight line anymore. It has already moved up significantly, and the market may have entered into a trading range. And if the market does enter into a trading range, then obviously selling Nifty when the Nifty is high and then buying it back when it's lower, while keeping that call protection on, is a very, very good strategy, because the calls are so cheap that if you get 2 cycles of selling and buying which are successful in terms of futures trading, then your call becomes virtually free of cost. And so whatever price you then have to sell that call is all profit.
Right. In terms of stocks, in terms of some sectors that you like, which are the sectors that you like, or which are the sectors that you would want to sell if you expect markets to see a big correction or any knee-jerk correction? What are the sectors that you feel have a lot of risk?
Well, certainly, the BFSI sector, not so much the finance stocks, but more so the banks in recent days, and the PSU banks, I think, have rallied a lot, and unless the NPA numbers start showing significant downdrift, there is a risk there. A lot of expectations have been built in. So I think the banking stocks are certainly looking overpriced. So that's one select set of stocks I would be very, very careful. We all know that Infotech and Pharma have not performed, and those are what I call the defensive sectors today, where maybe you could even start selling out of the money puts to go along these sectors once if in case they continue to react a bit more. But every other sector, I think, is currently overpriced. But the caveat is the markets can remain overpriced for a significant period of time.
Right. In terms of banking stocks, what do you think will take the stocks lower? PSU banks, a lot of PSU banks are yet to declare numbers. Do you think that could be a big trigger for the sector as a whole?
Well, the PSU banks have rallied a lot, but in terms of absolute valuation, you're not going to say that in terms of price to book value, they are very, very overpriced, unless, of course, the NPA story does not improve, and then you start questioning the book value itself. So to that extent, I think the PSU is a more difficult play, because it is not at 5 times or 6 times or 4 times its book value like some of the private sector banks. But some of the private sector banks certainly are at historical high valuations, And I find it a little hard to believe that when one part of the entire banking chain is struggling with 10% NPAs, that the private sector banks are having NPAs only to the tune of 1.5%. So maybe they've been very, very good with their lending, but at the same time, I think something's got to give there, and some kind of provisioning is going to kick in even in the private sector banks in the near future. And so the declines might be led actually more by the private sector banks than the PSU banks.
Right. Let's just look at the Nifty chart today. So, if you look at the chart today, we were up 50 points. Right now, we are down 30, 40 odd points. And this is not a case that is happening today. Every time the markets are going near that level, you are seeing selling pressure coming in. What does this tell you, Rajesh? At higher levels, people want to sell. There are positions in the market which want to sell at higher levels, which may not be a good sign.
So which is what I just said, that the market may have entered a trading zone because it doesn't look like there's a large scale volatility coming in, but 100, 200 points in the Nifty looks like it could happen anytime. So, and because out of the money calls are so cheap, exactly the strategy I said, that every time the market moves up, you buy some out of the money calls and start selling the futures, and then trade those futures 100, 200 points down, you buy back the futures and sell back the calls. So that's the kind of strategy I am advocating right now.
Right. So that goes with the strategy that you were saying. Let's talk about some stocks as well. So you mentioned about the banking space. What can one do? The strategy on Nifty. Let's talk particularly about Reliance. What is your call over there? I know you cannot comment on stocks, so you may not give us a strategy. But what is your view? How do you think Reliance can make the index move?
The re-rating in Reliance, the way I see it, is actually a fallout of the de-rating of the other large caps, namely Infosys, TCS, and some of the other pharma stocks. So in case, if funds have a strategy that they need to invest at least an X% of their capital into some really large cap liquid names, then Reliance, I think, has been the beneficiary of the de-rating of the infotech majors and the downgrading of the entire sector. So Reliance, to that extent, has benefited from flows, I think, that has come out of Infosys, TCS by the large funds, because some of their core holding needs to be in really large cap stocks, because where the liquidity is high and exit is easy. So to that extent, I think Reliance has been a beneficiary of de-rating of other stocks rather than re-rating of its own self based on the new business that it has gone into. So to the extent that the infotech sector will be subdued, I think Reliance will continue to see buyers at lower levels. But whether the stock merits investment at these levels or not, very difficult for me to say, because nothing much has changed for the stock in the last 5 or 6 months. We all knew that the telecom launch was going to happen, and these kind of pricing wars that it is indulging in, while it's going to harm the other players, cannot be beneficial to Reliance in terms of profitability. So we really have to see when these price wars end, what happens to the numbers in terms of subscribers. So fundamentally, I think it's an okay play, but of course it's the beneficiary of a lot of money moving out of other large cap stocks.
Right. In terms of technology, when you see such amount of de-rating in these stocks, there is always that temptation that the worst is behind, and funds would start to come to be overweight on technology pack. Do you think it's too early to take that call?
Well, these companies, of course, need to recycle themselves. I think the old business model is not going to work or not going to work very well. Artificial intelligence, there are a lot of areas, robotics, artificial intelligence, that are going to, take the prime space in terms of technology in the future. I think some of these companies need to start moving themselves into those directions. I'm sure they have already started the work in that direction. So in terms of the total pie available for technology, I think it's going to grow, because everywhere, every segment, I think we are using more and more technology. But it's just that there is a transition phase these companies are going into. I think the body shopping kind of days are behind us, and more intelligent, more value-added services need to be thought of. And I think some of these companies will eventually come out of that body shopping phase into more technology, real technology phase. And once that happens, I think these companies will be bought back, because they will become growth stories again.
Right. Just a word on the pharma pack as well. What is your call? A lot of strategists that we speak to say that last 2-3 years has been underperformance. Now they can do well. Again, you don't agree to that view?
Well, as I said, maybe it's time to start selling maybe out of the money puts in pharma stocks and buy them at lower levels if that were to happen. And if not, then you can continue to eat those premiums. So I think the way to trade it is I don't see them getting re-rated and moving up 40-50% in the next 1 year. Maybe 5-10%, which is great because then you can continue to sell those puts.
Right. Rajesh, thank you so much for taking out time for us. Always good to get a perspective from you.